Welcome back to my channel CPA to be, where we're going to continue with our second video of our Trust Accounting series. Today we're going to dive into accounting controls. The accounting control takes into consideration a lot of other details. Today we're going to put emphasis on the journal entries. The journal entries are going to be very important because your auditor is going to take a look at why you do certain transactions, and you need to give an explanation, and it has to be a reasoning behind. Although you might not be involved with the financial statements and the notes that must be in the financial statements, definitely all the notations that you incurred throughout your preparation and during the presentation of your paperwork to the law firm, it will be very beneficial for the CPA who would end up putting the financial statements and the notes that it would at the end be presented to the auditor. This series of videos, although it is not to put the bookkeeper as the only person involved in the audit, definitely is to put you as one of the key players in the preparation for the audit. Without any further ado, we're going to dive into today's video. Today, we're going to go back to the basic of accounting using T-tables. The reason for that is when you use a software such as Sage or QuickBooks, as you know, when you create an invoice, it's anything that you're going to receive money later on. And you later on have to receive that money. When you are creating that invoice and receiving money in the software, most of the time, it's very difficult to choose which accounts you're going to be hitting. Now, with this T-table, as you all know, this is the beginning of Bookkeeping 101, where you actually see the beginning balance of each of the accounts and also what happens, the debit and the credits. I want to do this because there is a lot of confusion sometimes when a trust account, you debit a liability instead of an expense account. This brings a lot of trouble to people. Not only that they bring problems, but then if you don't do it correctly, then you can commingle funds from the trust account and the operating account without even realizing. Any money that comes into the trust account is not operating money that the lawyer can use for anything that they desire. So they have to use the fund to cover expenses for the claimant. Therefore, when we create this is going to be part of the documentation that is going to support your analysis as to why you categorize the transaction the way that you did it. Now here we're going to start with the deposit. As you know, you have to create an invoice before you can receive the money. The invoice in this case, as you can see here, I put the debit and the credit, and it's going to be these T-tables are going to show you what happens in this specific transaction when you create an invoice and then later on you receive the money. I chose random numbers for each one of the accounts. So basically, you can choose any number as you know. When you create an invoice, in this case, we are going to affect, in this case, we're talking about an example of $10,000. So you are going to debit your account receivables, and then you're going to credit the, in this case, the accounts payable, and it's the one that is going to have a claim number. What I do, it is each claimant has a claim number, and then that it becomes the liability. And that liability account is the one who records every single transaction that occurs. Okay. Now, bear with me, because once we go to the T-tables, you'll see how this is going to make more sense. Now, once you are going to receive that money, what you do it is, as you know, you're going to debit then your bank account, your trust account, IOLTA, and you are going to credit the accounts receivable. Now, let's take a look at the T-tables. When we create for the accounts receivable, we're going to debit first the account with $10,000, and then the accounts payable account, it gets a credit of $10,000. This is the money that, as you know, it's for the claimant. And later on, we have, when we receive the money, we get, as you know, we debit the trust account and it received the $10,000. Now, later on, as you know, we have to do a credit to the accounts receivable. We see it right in here. So your accounts receivable at the end of the month, let's just say that this is going to be only one transaction, it's going to end up in zero. This is how it has to end, in zero, for example. And this is part of your accounting controls. If you have any balancing here, it means that you did not receive all the money. Correct. All right. Now, the accounts payable for the claimant, it's going to retain the $10,000 credit. And your IOLTA is also going to retain the $10,000. As you can see here, we are going to keep and balance the accounting equation where assets is equal to liability plus stockholders' equity. For the purpose of this, if we only had this transaction happening during that month, our equation is in balance. Now we're going to go into details as to how we make payments to a public adjuster, for example, a vendor, and the remaining funds in the account we disburse to the claimant. Paying the law firm, it's going to be a little bit more complicated. So we're going to go
into details in the next video. It's going to be just about that. That's how complicated it is that I just going to need one video just for that. Now, when we make a bill, the balance here has to match at the end of the month with the balance in the trust account. Okay. Now, the accounting control account, as you can see here, it ends up in zero. If these in the general ledger you see that there is any balance, that means that something paid out. And your IOLTA account, as you can see, it will remain with a $5,000 balance. We go back to the book, accounting equation. We still are in balance, $5,000 and $5,000. Now we're gonna go back to a vendor. A vendor, it could be any third party. We do the very same thing. Okay, I did this because in case anybody who works with public adjusters and so on, they know that it's the difference between the public adjusters and plumbers and so on. And the reason I do this is because later on you will know when it comes to the 1099s, the public adjusters they have huge one. Everybody else is not that more important. And once again, I do this distinction because it will be easier for the auditor to understand what happens with the public adjusters or that main vendor that you have and anybody else. Remember, this series of video, it is aimed at getting you ready and passing that trust accounting audit. So far, if everything that we are talking right now, it makes no sense to you, please stop and put your comments. Let me know what you are thinking so far. Let me know if you have any specific questions, and I would love to listen from you. If you feel that everything that you're getting here is definitely helping you give solution to your current trust accounting audit, please don't forget to share with anybody else that's in your team. Okay, now the third part is going to be the claimant account. Now we're going to be talking about the claimant and how we're going to disburse funds. The way that I do it, it is the claimant I recorded, as I initially said in the first video, as a vendor. Why? Anybody that I pay is a vendor, no matter what it is. For the claimant, I also create and I do is a bill, and then I register the payment as well. Why? Because that way the claimant, there is going to be a history attached to the claimant and all the payments that we make to them. So in here, we are going to be the same thing when we create the bill. We're going to debit the claimant's account, and then we also are going to credit the accounts payable, that the same one we use here. Again, this is going to serve you as an accounting control, and later on you will see how it shows up into the general ledger. Now we're going to go back. So since we know this is the same as before, we're just going to go straight to the T tables so we can see what is happening so far. Now when we debit, the beginning balance, as you know, in this claim number account is $2,000. Beginning balance of the account 23,900, which is transfer account if you want to call it, it's zero. It has to be zero. And then the beginning balance in the IOLTA account is 5,000, as you know. So let's see what happens after we make these transactions. We're going to debit the accounts payable for 1,500. Then later on, we're going to credit, as you know, the transfer account 1,500. We're going to debit. As you can see here, the beginning balance on the IOLTA account is $2,000, and we're going to credit 1,500. At the end of the month, IOLTA account remains with a balance of 500, and the claimant's accounts payable also 500. As you can see, we have maintained the balance with the accounting equation in every single transactions. At the end of the month, right again, and it ends in zero here. We have $500 and $500 in the debit. The balance of the $500 in here, as you can see, it would be technically what would be remaining to be paid out to the law firm. Again, this is just an example of numbers that I just picked random. And we're going to go into specific details in our next video as to how we send these $500 to the lawyer account.
Thank you very much for sticking with me to the end of the video. I want to give a special thanks to my son. He's the one who's helping me behind the cameras right now, doing the editing. I just wanted to let you know that we put a lot of emphasis, a lot of work, a lot of research, so we can produce the best quality video for all of you out there. So please, if you think this video brings any value to you or anybody that you know, do not forget to subscribe, to share the video, and to like it as well. As you know, YouTube algorithm works using all of that information, so we can be put in front of other viewers looking for the same type of information, and they can also benefit as yourself. Until then, I want to thank you one more time and have a great day.